To recap an eventful week on the markets, we speak to Bob Mason from FX Empire. Bob, thank you so much for joining us today. Let's jump straight in with a jump in UK wage growth, which took some pressure off the pound earlier this week. Overall, what are your current thoughts on the sterling?
Yeah, I think economic data this week's been pretty good. We saw even retail sales yesterday come in better than expected, despite consumer prices on the rise again after the BOE's rate hike. I think the problem with the BOE's rate hike is that normally you would expect some movement in the pound, but it's been under quite a lot of pressure because of Brexit progress. Obviously the EU and the UK government, trying to get to the point where they start discussing trade sort of agreements and so on. I think the pound's been a bit choppy, but I think really the direction over the next few months is going to be hinged on how the UK government is able to progress on trade talks and negotiations, and whether it looks favourable for the UK economy. Obviously, it's a bit of an unknown quantity at the moment. So economically, the data's been quite good, but I think it's been propped up by the fact that we've yet to really get into the meat of the negotiations for Brexit. So if trade talks start going against Britain, I would then begin to wonder whether the pound would be able to sustain itself. Obviously, UK wage growth was a bit better, but it's still lagging inflation. And then once you start seeing business investment, falling on the back of weak position for the UK government, I think there's going to be an issue for the pound. So I think we're expecting trade talks to start next week. So we could start seeing some movements quite quickly.
Moving over to the US, the Fed has fairly optimistic growth expectations for 2018. However, investors seemingly not so bullish. What is your take on the greenback going into 2018?
Yeah, I think obviously based on current economic indicators, the outlook's still fairly rosy for the economy next year. I think one thing that the Fed has done is it's incorporated some of the fiscal policy measures, particularly tax reforms, into the growth forecast for next year. I think one of the issues is just even the latest Democratic victory in Alabama. That kind of points to quite a challenging year ahead for the US administration in terms of being able to get other growth policies through. The markets were pretty bullish about the US economy. We had hopes of $1 trillion infrastructure spending plan on the horizon after tax reforms. With the balance of power now almost even, and Republican senators and so on not fully aligned with Trump's policies, yeah, maybe it is a little bit optimistic. I think from a corporate earnings perspective, obviously the tax reforms will certainly help. So it's really just about domestic consumption and whether it's sustainable. But you've got employment, the labour market's tightening. It's continued to tighten. It's forecasted to fall pretty low next year. So that should support consumption. And with the tax cuts and everything, that's a positive as well. But yeah, we were expecting more, and I question whether we're going to get that. So will the Fed be more hawkish, and will they go beyond 3 rate hikes? At the moment, it's looking unlikely just based on the fiscal policy side of things.
Finally, a bit of a different thing to look at, but this week seems to have been full of Bitcoin and crypto talk. How big of an impact is this having on, say, the more traditional side of the market?
Yeah, I think, the launch of the CBOE futures last weekend, was quite a poignant moment for the crypto markets. I think, we're going to start seeing institutional money redirect towards, the cryptocurrencies and Bitcoin in particular, and then we've got the CME starting, next week on Monday. So that's really the first step in terms of, the evolution of the markets into the sort of mainstream. I think when you look at, let's look at the Dow Jones, for instance. It's up 24% year to date. Let's look at Bitcoin. That's up 15,000% year to date. At some point, investors, as long as the bubble doesn't burst, investors are going to, sort of think, hang on a second, why am I looking at Dow Jones and all the hype around Donald Trump and the record rallies and so on, but that's only generated 24%. I could put in a significantly smaller investment, take a significantly smaller risk, but with significantly higher returns. So I think there has been a shift, but I think more so in sort of Asian markets, you'll see the retail side going in more. We're beginning to expect the ETFs and the sort of hedge funds start to launch once the CME Group futures start next week. So that will increase the volumes, and once the big players are in, I think the smaller players will have to start following. We're hearing the likes of Aberdeen talking about it being a bubble, Aberdeen Asset Management. Okay, well they can say that, and a lot of people have said that, but at some point they're going to have to admit and say, well, actually, hang on a second, we have to start looking at that as an asset class. Otherwise, we're going to be left behind by the rest. So I think there is a shift. I think it's still quite nascent. I don't think we're necessarily seeing significant drops in volumes in the mature markets, but it's drawn in a very different type of investor. So the investor span has widened. And yeah, if it continues going, it's only a matter of time before even the most skeptical are going to turn around and go, right, I'm out of equities and I'm into cryptocurrencies.
Bob, thank you so much. It's always a pleasure speaking to you, and I hope we can speak again soon. And thank you for watching. And if you like this interview and would like to find out more, be sure to head over to dukascopy.tv.